Thank you very much, Peter. I'd also like to start by thanking Marketforce and IEA, as well as all the sponsors, for including me today. It's a delight to be here, rather than to be with those noisy derivative traders in Boca Raton who are meeting this week. I have to admit, Cheltenham is not really on my radar for a social event. My remarks are supposed to be about putting post-trade in context, the impact of economic trends. There's, I think, 15 minutes or so allocated to do this. So I'm going to define the context as consisting of just essentially two actors, three aspects of post-trade, two geographies, and two economic trends. So if I've left out your favorite actor, geography, aspect of post-trade, or economic trend, we'll have to deal with that after my remarks. One thing I want to start off really by emphasizing is that one of the goals in many of the regulatory reforms following the global financial crisis was for common policies internationally. And as I talk about priorities for the actors I'm going to focus on today, that's still something that's in the background. If you're going to take anything at all away from what I say over the next few minutes, that point should be that divergences in economic trends between the US and Europe are making what was already a difficult goal of common policies even more difficult. And I will go into that in more detail over the next few minutes. My focus is going to transcend equities. I'm going to talk about post-trade much more broadly than the previous two speakers. Equities are certainly part of this. I have three types of actors: intermediaries and end users, essentially banks and their clients. I have regulatory agencies, governments, legislative bodies that set the context in which we all operate. And I have opportunists. I'm not going to say much about opportunists. I am going to acknowledge, however, that Nasdaq OMX would fit into that category. The priorities that I have laid out here are mine. These are not necessarily the priority rankings on the right-hand side in the order any of these groups would particularly publicly say themselves. But it's my perception as an economist of what their priorities would be. So for the banks and the end users, first and foremost, would be maximizing the use of capital. And that takes two forms. That's margin efficiency, and it's also operating efficiency, because operating efficiencies impact the bottom line, impact the capital position of banks and of end users. The second 2 points are a little more problematic in terms of the ordering, but I think recent events bear out that avoiding market power or the concentration of market power has emerged as an important objective both for banks and their clients as well as for regulators. With the former group, one thing to bear in mind that market power, if you're a commercial enterprise, is always bad for other people but okay for yourself. So this is avoiding concentration of market power in infrastructure providers such as ourselves or in your competitors. Finally, and I think least importantly, at least behind closed doors for banks and end users, is the systemic risk implications of how the post-trade environment finally emerges over the next few years. That's the opposite viewpoint, of course, for the governments and regulators. They have, quite frankly, had enough of systemic risk being created from the financial services sector. And that, I think, has been minimizing systemic risk and the systemic risk implications of the future outlook for post-trade infrastructure is going to be first, second, third, fourth, however many priorities you want for most regulators. As has been made fairly clear with the Deutsche Börse NYSE Euronext merger decision, market power and avoiding concentrating of market power is also a priority in post-trade. Capital efficiency matters. We'll talk in a couple minutes about how it matters, but it probably matters the least, because essentially at the end of the day, politically, you're talking about the profitability of banks, and that's not a winning position for any politician on either side of the Atlantic to support. What about the economic trends? Just taking, again, a very limited number of economic trends across the geographies I'm going to talk about. Forecast for the Eurozone for the next couple of years is a recession. Not a horrible recession, but a recession nonetheless. I think we're all aware the banking sector is increasingly dependent on public funding. There's a whole host of initiatives that have been put in place with more acronyms that we could add to the ones we've already acquired this morning. UK, maybe a little better. Other parts of the non-Eurozone EU, maybe a little better than the Eurozone itself, both in terms of the outlook for the economy and the outlook for the banking sector. United States, not great growth outlook, but certainly by the context of what Europe, in the context of what Europe is looking at, it's pretty good. 2.5% economic growth is a common forecast. The banking sector is increasingly moving away from public support. Stress tests that were announced yesterday went rather well for the banking sector. So this is the two economic contexts I'm going to be referring to. All right, so let's start trying to tie all these things together. We've got systemic risk. We've got systemic risk as it is prioritized by different actors. We have the outlooks in different economies. From a strictly economic perspective, as I indicated a few moments ago, heightened protections against systemic risks are warranted. The financial sector, for the first time in 80 years, took down the real sector in the global financial crisis. We could argue all day, and people do, about exactly how that happens, but I think that's a commonly accepted view. Bringing OTC derivatives into clearing or trade reporting repositories are two ways to deal with systemic risk by increasing prudential protections. There are others. When we talk about the economics, the impact of the economic environment on these issues, weaker economic conditions in Europe mean there's a greater emphasis on systemic risk. And there will continue to be a greater emphasis on systemic risk as EMIR becomes legislation and then works through the regulatory process than for DoddFrank. The U.S., we have a stronger banking sector. We have a better economic outlook, and the efforts to, if you will, mitigate some of the impacts on the financial services sector on Dodd-Frank are ongoing and are apparently reasonably effective. So we think about implementation, and we think about this goal of a common global approach to some of the issues in post-trade. Implementation in the U.S. is apt to move further away from the legislative goals set in our enabling legislation, Dodd-Frank, than is the case here, at least the way the economy looks right now. I think that theme rolls over into this notion of capital efficiency. It's widely understood, as the preceding two speakers have indicated, that Europe has much to gain, and probably much more to gain, from competition, from interoperability, and post-trade efficiency. And just to recap the economic issues around post-trade efficiency: high fees, excessive margin requirements, drain capital, hurt banks' earnings, hurt end users, in much the same way, although that's not on the slide. Ultimately, again, speaking as an economist, inefficient post-trade processes, you can get misallocations of capital, you can get slower economic growth. It's something that as both an economist or as a central banker, you would like to eliminate. Sovereign debt crisis, additional regulatory burdens, the recession that's already beginning in Europe and is well underway in parts of Europe, more stress on the banks. That reinforces the need for efficient post-trade. It reinforces the need for efficient use of capital for margin. U.S., probably more concerned about the efficient use of margin capital than about operating efficiencies. As has been indicated, we don't have fragmented clearing houses within asset classes, across asset classes? Yes, we do, but not within a single asset class. As the implementation phases move forward, what's likely to be the outcome is there will be more emphasis on trade repositories and less emphasis on clearing as Dodd-Frank moves into implementation. To the extent that European post-trade processes can show material benefits, particularly from cross-asset class clearing, the U.S. may follow, but I don't think that type of action is particularly likely in the near term. Market concentration was something that I spent a lot of time talking about 2 years ago, and it's kind of come off the radar until, well, it never really came off the radar here in Europe, but it's starting to come off the radar in the United States. So the question is, how many clearing houses, how many post-trade facilities do you want? Capital efficiency essentially says one. And you want as many asset classes as you can possibly have in it because the correlation structures are such that you will maximize margin offsets, you minimize capital requirements. Well, okay, that's fine. Who runs it? Who owns it? Who gets paid for operating it? So one clearinghouse, either for a single asset class or for many asset classes, has market power. The systemic risk issues about one clearinghouse for a single asset class in a given geography, either in Europe or the United States, or about one clearinghouse for many asset classes is not settled. Is it better to have multiple smaller baskets or one big basket that's holding all your eggs, if you will? I think more fundamentally, and again, acknowledging the political realities that all this process is taking place in, regulators don't really want to be faulted for creating monopolies or near monopolies or sources of market power that create inefficiencies, because we're trying to get rid of inefficiencies in some cases here, and perhaps create more systemic risk. So post-trade issues around market concentration, particularly here in Europe, have focused on strategic initiatives of the firms that provide financial market infrastructure. As we've seen, there have been decisions to try and avoid increases in market power for the intermediaries that exist. U.S. market power of the intermediaries is taken as essentially a given. There is one clearinghouse for bonds, there was one clearinghouse for cash equities, there was one clearinghouse for options, there's essentially one clearinghouse for futures. And the regulatory process is what's used to try and mitigate market power. The economic outlook is such, or the economic impacts, again, in Europe and the U.S. diverging the way they do, is very little outlook in the U.S. for change and the concentration of the various post-trade intermediaries that exist. Europe, again, I think the focus is on systemic risk. Bigger is not necessarily better until the process around, if you will, the feeding of product into post-trade is resolved. So once we have cash equities no longer operating in national silos, interoperable, competitive, once we have products that are not necessarily centrally cleared, then the question, I think, in Europe of market concentration versus operating efficiency may turn away from avoiding market concentration. To conclude, so you're not being burdened with a lot of economics, as Urs said, we're just going to keep this short. EMIR is turning toward implementation. Dodd-Frank has been in implementation stage for almost 2 years now. So both sides of the Atlantic were turning to this question of, okay, we have some legislation, or we'll shortly have some legislation. What, in fact, does it mean? I think that the recent economic stresses in Europe and the ongoing economic stresses for the next few years mean that EMIR is, as it's implemented, is much more likely to look like as the form in which it was written and the form in which Dodd-Frank was written. than is the state, and that is the likely outcome in the U.S. The SEC and the CFTC, the two main implementation agencies in the U.S., are having a great deal more trouble implementing DoddFrank in a form that looks like the enabling legislation than I expect ESMA to have as they work through trying to implement the legislative obligations they have. So again, to summarize, economic outlook, state of the economy here in Europe, particularly in the Eurozone, is such that the focus post-trade and post-trade, the emphasis of post-trade changes from the regulator is going to be on reducing systemic risk. The leverage for them to accomplish that exists, given the nature of bank funding and the public entity support for banks. So it's in this context which we're all looking at the outlook for post-trade, whether we be banks and their end-user clients, whether we be the regulators and the government entities themselves, or whether we be opportunists like Nasdaq OMX. Post-trade here is going to have, I think, a much different outcome than is the case in the U.S., and with much more emphasis on systemic risk reduction than on other issues that may be of concern to people in this room. Now, I am not going to be part of the panel, so I am slated to take questions now, but I know you have a wonderful panel coming, and so if there are no questions that are immediately pressing, I will leave the podium and catch up with anyone who wants to talk later on.
We can't lure you back to a seat here and join.
I think we're short on seats to be on our microphones.
Just here.
Or something like that. We have an infrastructure constraint, gentlemen.
Oh, of course, the microphone problem.
Yes.
Ah.
Though I can yell, but no, I don't think that's
okay.
All right. Any questions for me? In which case, I'll turn to the panel.
Yes, this is something I must confess I haven't taken on board, that Frank is rooted to this microphone, whereas both Urs and Hugh and myself are mic'd up. So are there any questions for Frank at this stage from the audience? I mean, I thought what was really interesting was this idea that the weaker economic conditions here in Europe are going to see this greater emphasis on dealing with systemic risk in the continent here. And I guess implicitly in the way you described the process of Dodd-Frank and the implementation of Dodd-Frank and EMIR, the risk is that in the post-trade sector, there is going to be now the risk of a divergence of implementation across the Atlantic, which is going to make it much more difficult to achieve the famous level playing field.
Yeah, I would agree. I think the level playing field was never that much a center point of equities, because I think people were relatively comfortable with equities on the systemic risk side. But for other types of products, I think the level playing field is going to be much harder to achieve given the way the economies diverge.
And that's a very sobering thought for the OTC derivatives market, which of course is a global market, and maybe this is yet another pressure towards fragmentation, along with other things we'll be discussing later, like the proliferation of CCPs.
Yeah.
As you see, Frank is standing here willing and eager to answer questions. There's a hand gone up there. I think, is it John Tanner from the LSE? Could you confirm or deny your identity as you get the microphone?
You're right, it's John Tanner, London Stock Exchange. In that presentation, you distinguished at one point between Eurozone, non-Eurozone EU and US. But then I guess most of the rest of what you said was just one side of the Atlantic versus the other side. Given, for example, the ECB's avowed hope or intention to try and make all euro clearing be in the Eurozone, do you actually see more of a split happening in the future between the Eurozone and non-Eurozone Europe?
It was exactly that issue as I was drafting this that caused me to sort of eliminate the non-Eurozone EU from the balance of the slides, because that balance of the points, because that's a huge determinant for whether there is a significant difference between the Eurozone and the non-Eurozone. The point, I think that position ties back to the systemic risk argument. CCPs CSDs, sort of financial infrastructure, are backstopped by a central bank. When push comes to shove, a central bank is going to focus on issues related to its domestic economy first and foremost. And that's a concern, obviously, between the position of the ECB. There's, I think, frankly, some validity there. I mean, I think if we had euro products clearing significantly in the United States, and the United States faced a financial crisis around clearinghouses, those would be an afterthought. Now, the Americans may be more insular than the Brits toward the Europeans, or the Europeans toward the Brits, but maybe not. And we certainly saw some things with bank failures where there were extraterritoriality issues that didn't necessarily resolve themselves the way we would like to see them resolved. To the extent that the non-Eurozone economies diverge from the Eurozone, and this is the point that Peter was talking about a moment ago with the US, the demands to have separate and distinct outcomes for post-trade are simply going to strengthen. Now, your biggest trading partners in the UK or Europe and vice versa, so it's unlikely that the economics of the two economies are going to diverge significantly, but it's not impossible. So again, more divergence you get, the more pressure there's going to be to have unique post-trade solutions for what is essentially emerging would be emerging as two different economic structures. So, you know, there's obviously, I'm not the first person to say there's a lot at stake, but there's a lot at stake.
Well, as Frank is looking so comfortable at the lectern, we'll leave you there for another 5 minutes. And if there are any questions to all members of the panel, to other members of the panel, now's the time to put it. I was very struck at the way Hugh stressed the importance of competition and alongside that access. And also, Urs, you also mentioned the vital importance of customer choice. And that's at the same time as the subtext of a lot of the remarks here, that what we're going to be seeing over the next years is really the tension between safety and competition. I always think competition in the clearing and settlement sector, it's a bit like cholesterol. You get good competition and bad competition. It's very difficult actually pinning down what it is. But any more questions? We've got about another, I peer at my watch, a good 5 minutes for questions before we summon the next panel to the podium. Yes, I see two. First, Robert Barnes in the front, and then John Sericold at the back. So, Robert, if you could take the mic and...
Yes, thank you, Chairman. Robert Barnes, UBS. Frank, thank you for your insights. Nasdaq OMX is a very special organization, a global perspective, technology that's used by markets around the world, including very publicly Singapore, Australia, transatlantic scope in terms of markets, cash, derivatives, funds, and others. Could you share with us your insights from a Nasdaq OMX perspective? What's your strategic vision of how we can promote liquidity recovery? Are there any products or trading strategies in the over-the-counter space that might have more affinity with an exchange model? And is there something that we can do together, users and the exchanges, in this great regulatory framework to try and do more business? Thank you.
What's the corporate strategy for the next 5 years? I think that's a different way to phrase that question, Robert. Thank you. There certainly is. One of the things that I didn't spend a lot of time on in the slides was a credit rating downgrade of the banks in the US, which caused a number of end users to begin to question their counterparties that they had in swaps and how they want to handle that. Right now, there are distinctions between exchange products and non-exchange products that in many ways are somewhat artificial. Probably from the economy's perspective, there would be benefits if certain exchange products cease to be on exchanges. There's not enough liquidity in some of them to really justify them being on exchanges, and they exist there simply for regulatory reasons. There are other products that do not trade on exchanges that probably would benefit from trading on exchanges. The problem we all have, this relates to conversations I've had with a number of people in this room, or at least organizations I represent, is it kind of gets back into this dividing the economics discussion that Urs was referring to. How do we set these things up in a way that's mutually beneficial for all the participants that are involved, so that the end user, the end client, the brokers and the banks, the exchange or other infrastructure operator, and it's a constant challenge to do that, because there are areas in which we compete and there are areas in which we would like to cooperate. The particular products that we are moving into in the Nordics are OTC repos and OTC swaps in the clearing function. It's not something we used to do. It's something that the Swedish FSA and the Swedish Central Bank have been very much supportive of doing, and it's frankly not going to be a huge profit center for us, but it provides benefits to the end user community in Sweden and the banking community in Sweden. It's a model I'd like to see duplicated, but there are places where we operate, the United States being one, where the relationship between the exchanges and the broker community is much more contentious than it is in Sweden. And so I think it's going to be difficult to duplicate that everywhere, at least in the short run. But it's a great question, because in its sense it says, as one of the keynoters pointed out in an earlier IEA Marketforce conference I was at, we got to remember the end clients. Yes, we're all, or at least many of us here, compete with each other or are clients of each other or vendors to each other, but there are end users for all these products. And essentially the systemic risk point is also about that. There's a broader economy which we all serve.
Fine, thank you. We can squeeze in one more question at this point. John Sericold, and then I'll summon the rest of the next panel. And Urs and Hugh will be in the next panel, so any questions for them, you've still got them captive, as it were. So John.
John Sericold from the ICMA. I want to go back to what you said about central banks only looking after their own because they're domestically accountable. So I guess the definition of system underlying the term systemic risk means domestic system. But I wonder whether the existence and use of US dollar swap lines in particular between the Fed and central banks elsewhere in the world is evidence that some of the lessons of the adverse extraterritorial effects of some insolvencies have begun to be learnt, so that people are prepared to put prophylactic measures in place rather than allow, for example, European banks' US operations to fail for want of liquidity?
It's a great question, John, and it's one of the questions that always makes me wonder where the press is. It's not so much the central bankers I'm worried about. Okay, I think the swap lines is a terrific point. The central bankers understand the international nature of the financial markets and are willing to cooperate internationally. The central bankers do not operate in a vacuum, and if we go back to the financial crisis in the United States and I think elsewhere, there was a lot of criticism of and potentially interference with or threats of interference with the operation of central banks from other parts of what we call government entities. And that's where I think the difficulty would lie in supporting financial institutions that benefit someone other than your own in another crisis. It's more with the political side of the equation than with the central bankers themselves. And again, in the context of the crisis, the political environment with which the central bank operates became much more important than is normally the case, and is the case in the swap lines. The swap lines, I have a feeling many people don't even understand what they do or why they're there, and it's a non-issue. And so they can operate in a way that bankers operate. Again, for a lot of us, if we do what we do well, nobody knows what we're doing. I mean, the fact that we're not doing it well is when all of a sudden we're on the front page about how we happen to be operating our businesses. So that's my view. It's not the bankers, it's the people that ultimately the central bankers have to be answerable to.